Personal income up 0.6% in January. That is after a 0.2 gain, the initial release at least, in the month of December. Personal spending up 1.8%. That's better than the 1.4% expected. The PCE numbers, here's what you care about. The inflation numbers on a month-over-month basis up 0.6%, bigger than expected and much bigger than the 0.1% that we saw in December. The year-over-year number for the headline is 5.4%. We were at 5%, so we bounced the wrong direction. The core up 0.6. That is double. Well, that is now here are the revisions. That is 2 ticks higher than what it was in December.
Wow.
And puts the year-over-year at 4.7% after 4.6%. So inflation stronger. Personal income is stronger than it was in December, not as strong as expected, and personal spending is up a 1.8%. So Americans are still out there spending. I'll try to dive into the details. And John, I bet you have some movement in the market.
I mean, you can guess where it is, and I think everyone listening can guess where it is. Equities are down on the S&P by just a little more than 1%. That's a session low. In the bond market, yields up at the front end by 5 basis points, 4.75. That's the highest level on a closing basis that we will have seen since 2007. On a 10-year, up 5 basis points to 3.93. So, Tom, it's yields up, stocks down, upside surprise again on inflation data. That is not what we wanted to see.
I'm trying to impress Alarian here. I'm going to do the math in my head here. But on the core deflator, the survey with previous statistic was 4.35%, and the data with the revision is 4.65%. 4.35, John, up to a reality of 4.65. To me, that's a demonstrable move.
So I get that it's old news, but Mike, I've got to ask it. If the Fed had the January data on February 1, would that news conference, that meeting have been much different?
I suspect it would have been if they'd especially seen the strength in the jobs report, which came out 2 days after their meeting. And then if they knew where inflation was going, they might not have done 25. They might have gone with the Mester Bullard camp and done 50 again if it had come out that way. Let me give you a couple more numbers here that matter. A lot of talk about people going into debt to keep this spending up, but the savings rate rises to 4.7% from 4.6%, the second consecutive increase. So it looks like people are still saving something out there instead of just buying everything on credit.
What does it say to nominal GDP? What does it say to the animal spirit that companies have to adapt to? I mean, inflation can be good for companies too, because revenue comes in better, right?
Yeah, absolutely. For companies, as long as their margins, they're making it on the margins and raising prices faster than their expenses, then that helps them. That was one of the foundations of the stock market for years until we got into this low inflation environment. And that's one reason it's been harder for companies to keep up the kind of growth that they used to have.
So, Mike, I got an email moments ago in response to this economic data, and it said this should be called the core inflator. Now, can you tell our audience, your best place to do this, what is the greatest distinction between the CPI data we had a week or so ago and, say, the PCE core deflator? What is all that?
Well, it'd be PCE. You could just call it an index, but basically they use the PCE numbers to deflate, to adjust for inflation, the GDP numbers, which is why they call it a deflator. It could be easily called, in this case, an inflator this month. But the biggest differences are in medical care. The CPI is what you pay for medical care, and the PCE takes in what insurance pays as well. And then in housing is a much smaller component of the PCE than it is of CPI, so that does matter. I'm looking here to see if we have an update on the number that does matter, which is the core services X housing. And let me just type this number in here and see what we got. It hasn't updated yet our numbers, but we'll continue to look for that, and we'll talk about it on your show, John. One thing I can tell you is that wages were up a huge amount in January. Now, this is not totally unexpected because it's when everybody gets their raises, but they were up 0.9%, which follows a 0.4 gain. And then the one that everybody's going to want to see here, or we're going to want to see, is Social Security, because of the big increase in the COLA this year.
Yeah,
Social Security payments went up 9%. So that's going to be one of those graphs that
Interesting.
breaks the graph like we had with
pandemic
jobless claims during the pandemic. So that's where a lot of this increase in incomes comes from. And incomes were lower than people thought they would be.